Welcome to Breaking News to Trading Moves. For 6 decades, really, the world of investing has been defined by one man's singular approach to building a corporation. Berkshire Hathaway has long been synonymous with the wisdom, the stability, and, the sheer longevity of its leader.
And now, that era of singular stewardship is officially concluded. We are looking at a crucial, formal moment of executive transition that has immediate, quantifiable effects on the stock market.
Yeah, effects that extend far beyond just Berkshire's own balance sheet.
Absolutely.
The headline event is, on the surface, pretty straightforward.
Yeah.
Greg Abel has officially taken the top job. He's stepping into the role that Warren Buffett used to build Berkshire into this sprawling conglomerate.
A conglomerate valued at over $1 trillion, built over a nearly 60-year run. It's an incredible legacy to step into.
It is, and what's crucial here is the immediate market visibility of this event. The first full trading day of this official transition, it provided a very clear signal.
A very clear one. Berkshire shares, both Class A and Class B, experienced measurable downside pressure.
And the context here is critical, isn't it?
It's everything.
That localized selling pressure, it happened even as the major market indexes were climbing higher. It showcases this definitive split between general market optimism and, well, specific concern over Berkshire's governance.
Right. This immediate decline is the textbook definition of succession discount, risk making its presence known.
It is the market translating uncertainty into a lower price.
Exactly. So our goal now is to provide you with the framework to understand that reaction. We'll examine the operational context surrounding this transition and then move specifically to identify the designated winners and losers in the ecosystem around Berkshire Hathaway.
Okay, so let's look closely at the mechanics of this handover, because the sheer scale of what Greg Abel is inheriting really dictates the market's response.
The scale is almost impossible to overstate. I mean, Abel is taking the CEO position after Warren Buffett provided 6 decades of unwavering stewardship.
He didn't just run a business. He created an investment philosophy that became the company's operational identity.
That's it, exactly. He grew Berkshire from a failing textile mill into one of the world's most stable and complex financial entities. So this transition is less about appointing a new manager
and more about naming the successor to the most famous capital allocator of the last century.
Precisely.
And what we immediately saw was the market confirming that intangible value is now subject to repricing. The concept of the succession discount, which had always been a theoretical concern, a risk baked in.
Right, something people talked about for years.
It's moved from a theoretical possibility to a measurable fact on the ticker tape.
It became measurable immediately. We saw that specific observation in the price action of the shares. Berkshire Hathaway Class A, that's ticker BRK.AA, and Class B, ticker BRK.B.
Both of them.
Both declined on the first trading day following the official transition announcement. This is the market explicitly stating that the certainty and the stability provided by the previous regime are now gone.
Replaced by a measurable degree of uncertainty. And again, the contrast is what drives the analysis here. This wasn't selling pressure driven by a broad market correction or some economic slowdown.
No, not at all. It was highly localized to Berkshire, occurring exactly while the S&P 500 and the NASDAQ were advancing. It emphasizes that the valuation concern is company-specific.
Driven entirely by governance and capital allocation risk.
So when we place this transition into its immediate financial context, 2 aspects really dominate the discussion and Abel's early tenure.
Okay.
The size of the company's liquidity reserve and the recent changes in their investment portfolio. These 2 factors establish the parameters for every decision Abel is going to make.
Let's start with that liquidity reserve, or what we often call the war chest.
The war chest, yeah.
Berkshire is currently sitting on an unprecedented amount of cash, approximately $381.7 billion as of their most recent reporting on September 30th. That figure is just staggering.
It is staggering, and it reflects a crucial duality. On one hand, it's a testament to the operational success and cash generation capability of their diverse operating subsidiaries, Geico, BNSF Railway, the energy utilities, and so on.
But on the other hand,
it represents a massive capital deployment challenge for the new CEO.
The challenge, of course, is one of scale. For a company valued at over $1 trillion, finding an acquisition that is large enough to even register, let alone meaningfully contribute to earnings growth, that becomes incredibly difficult.
It's a high-class problem, but it's a problem nonetheless. If you acquire a $10 billion company, it barely moves the annual growth rate.
Right. So that $381.7 billion cash pile is immediate potential energy, but deploying it effectively without overpaying is now Greg Abel's defining operational hurdle.
The market has to assume that Abel will be far more active than Buffett was in his final years, simply because that cash balance is just too high to ignore.
And at the same time, we're seeing investors question the direction of the core investment portfolio based on recent documented activity.
Yeah, that recent activity is the evidence of portfolio trimming. The company has publicly reduced its positions in two of its most prominent long-standing holdings.
Apple, ticker AAPL.
And Bank of America, ticker BAC.
Okay, so this trimming activity happening at the same time as this record cash balance, it immediately raises questions about Abel's and his team's view on current market valuations, on concentration risk,
and on the future strategic weight of technology versus financials within the overall Berkshire structure.
The market is interpreting this as potentially the start of a reevaluation of the entire equity portfolio.
It has to.
So we have the backdrop, a $381.7 billion imperative, recent trimming of major holdings, and a confirmed measurable succession discount on the stock price. Based on this, what are the three immediate areas of focus the market will use to evaluate Abel's effectiveness in the first few months?
Okay, these three questions will define how quickly, if at all, that initial discount is closed. The first is naturally capital deployment.
Right. That means focusing on how Abel will utilize that enormous cash pile. We need clarity on his specific execution strategy for capital use.
Precisely. The options are well defined, and his choice will send a clear message. Will he execute aggressive stock buybacks to signal confidence and support the stock price?
Or will he focus on numerous smaller, what we call bolt-on acquisitions? Those are easier to integrate into existing Berkshire operations.
Or does he attempt that rare, massive acquisition, the elephant hunt, which would require an enormous, high-quality target to make a quantifiable difference at Berkshire scale?
The decision he makes here is the first real clue about his urgency and his comfort level with current market valuations.
Exactly. The second area focuses on portfolio decision-making. For 6 decades, Buffett was the public face, the architect, and the ultimate decision-maker for the entire equity portfolio.
And that visibility is now a question mark.
Yeah, it is. The market needs to know who will emerge as the public representative for the equity book under Abel's leadership, and critically, how active will that portfolio management become? Buffett was famous for his long holding periods and low turnover.
Any deviation, a higher velocity of trading, or a sudden preference for different sectors will be analyzed instantly.
Yeah. So it's about the continued consistency of the investment philosophy. If the new leadership shifts toward a more active or maybe a less transparent management style, the perceived risk level rises.
And that could make the succession discount more permanent.
And that leads directly to the third question, the discount timeline. We observed the immediate repricing, but the market wants to know, will this succession discount on the stock price fade quickly, viewed as a mere short-term sentiment event?
Or will this uncertainty linger? Will it persist, casting a shadow over upcoming earnings reports, shareholder communications, and the anticipation of the next annual meeting?
The persistence of that discount is the true, hard metric of market confidence in the new regime. If Berkshire consistently trades at a lower valuation relative to its intrinsic value, it signifies that the market believes Abel has yet to provide the necessary clarity or demonstrate the capital allocation prowess required to fully restore the Buffett premium.
So the timeline of that re-rating process is the final question investors are asking themselves today.
So it is.
That extensive context gives us the landscape. We understand the pressure points and the challenge of the cash pile. Now, let's transition our focus and explore the specific market participants who are identified as potential gainers from this whole moment of transition and uncertainty.
Okay, so this segment is dedicated to 3 distinct market categories that stand to potentially gain, either by capitalizing on temporary uncertainty within Berkshire's operations, or by benefiting directly from the strategic decisions Greg Abel is now compelled to make with that massive liquidity reserve.
Our first winner category targets the core engine of Berkshire, its insurance operations. We're looking at auto insurance competitors.
Yeah.
The angle here is simple. They gain potential market share if momentum at Berkshire's Geico unit stalls.
This point relies on the foundational structure of Berkshire Hathaway. The insurance unit, particularly Geico, is the most crucial operational earnings generator. Crucially, it provides the famous float.
Right, and we should define float clearly. It's the capital that Berkshire holds between the moment they receive a premium from a customer and the moment they pay out a claim.
And this float is effectively capital that they get to use for long-term investments without having to pay interest on it. It's the cheap fuel for the entire Berkshire investment engine.
So if GEICO experiences any internal distraction or a slight execution wobble, whether that's in pricing strategy, technology rollout, or customer retention, during this high-profile leadership change, it poses a direct threat to the flow of that precious zero-cost capital.
Exactly. Even a temporary loss of focus or operational laxity at GEICO creates an immediate and quantifiable opening for rivals.
Because auto insurance is a fiercely competitive, highly pricing-sensitive business.
It is. So competitors can adjust their retention strategies, deploy more aggressive advertising campaigns, or seize a momentary pricing advantage. Any wobble for GEICO translates directly into market share gain for the peers.
So let's name the companies specifically identified as positioned to benefit from this scenario.
First, we have Progressive Corporation, ticker PGR. Progressive is often lauded for its agility and its technological superiority in pricing models.
They operate with extremely detailed analytics that allow them to react to market changes and competitor weaknesses faster than almost anyone else.
They're very sharp. So if GEICO is distracted, PGR is positioned perfectly to snatch market share by optimizing its pricing against a potentially slower-moving competitor.
Then we have Allstate Corporation, ticker ALL.
Another industry titan with massive scale. Their advantage is the ability to absorb flow. If a large segment of GEICO customers may be seeking stability during a perceived moment of managerial flux, decides to shop around.
Allstate's scale and brand recognition position them well to capture that volume.
And rounding out this category is the Travelers Companies, BINC, ticker TRV. Travelers focuses on a slightly different mix of insurance products, but remains a major player that benefits from any overall cooling of the competitive heat brought by a fully optimized GEICO.
So if the management focus required for the Abel transition diverts attention from day-to-day insurance operations, these three companies gain an immediate competitive edge.
That's the idea.
Okay, moving to our second winner category, we look at where the deployment of that massive liquidity reserve would send capital. We are focusing on deal advisors and investment banks.
Right.
The potential gain here is the upside in advisory and financing fees.
This is a direct play on transaction volume. The simple arithmetic dictates it. Berkshire's $381.7 billion war chest is too massive to sit idle forever. Greg Abel is under pressure to deploy it.
And any deployment that involves a large-scale acquisition or even a series of complex bolt-on deals requires specialized advisory and financing support.
It does. And even if Berkshire executes a pure cash deal, meaning no external financing is needed for the purchase price, these types of complex, multi-billion-dollar transactions always require extensive legal counsel, valuation services, due diligence support, and negotiation advisory from major investment banks.
So any major acquisition attempt, successful or not, generates substantial guaranteed fees for the intermediaries involved.
This means that Abel's mandate to deploy capital translates directly into revenue opportunities for the largest, most sophisticated advisory firms.
And the companies identified here are the undisputed giants of the advisory world, capable of handling the complexity and scale associated with trillion-dollar clients.
Leading the list is the Goldman Sachs Group, Inc., ticker GS Goldman Sachs, is globally recognized as a leader in mergers and acquisitions advisory.
They possess the necessary global footprint and expertise to counsel Berkshire on complex M&A strategy, including identifying, valuing, and executing on potential large-scale targets.
Both domestically and internationally. Then you have Morgan Stanley, ticker MS.
Another investment banking powerhouse.
Their capital markets expertise and deep relationships in sectors like technology and infrastructure make them perfectly capable of structuring and advising on the kind of massive corporate actions Abel might be contemplating.
And finally, J.P. Morgan Chase & Co., ticker JPM.
Right. And while they're known for their vast commercial banking operations, its investment banking arm is equally formidable. Its extensive balance sheet and comprehensive global banking capabilities mean it is exceptionally well positioned to provide any necessary bridge financing or complex legal structuring.
Or really any ancillary transaction support should Abel pursue an acquisition path.
Exactly.
Our third winner category moves beyond direct competition or transaction fees and focuses on capital flow and investor sentiment. Berkshire Alternatives for quality compounding.
This is about the potential rotation of conservative investor capital. The rationale here is rooted in investor psychology. Many investors were attracted to Berkshire not just for its performance, but because of the Buffett premium that perceives safety, the disciplined capital allocation, and the deep alignment of interests with shareholders over the long term.
So if that premium is now being compromised by a persistent succession discount, these conservative long-duration investors might see diversification or new homes for that capital.
They might. These are investors prioritizing stability and predictability above high-growth returns.
And if Berkshire shares are now trading with a persistent uncertainty discount, they might look for other U.S.-listed companies that resemble the holding company style, run by similarly disciplined capital allocators.
But without the immediate governance question mark, this capital movement is an active attempt to maintain the core philosophy of conservative long-term compounding while avoiding the valuation compression risk now attached to Berkshire.
They're looking for the next stable compounder.
That's the idea.
And the companies identified as potential beneficiaries of this rotation are highly regarded peers operating a similar model.
The first is Markel Group, Inc., ticker MKL Markel, has frequently been compared to Berkshire in its structure. It operates both specialized insurance segments, providing that critical float, and manages an investment portfolio guided by a strict long-term philosophy.
So for investors rotating out of a discounted Berkshire, Markel offers a ready-made, philosophically similar destination for capital.
It does. And the second is Lowe's Corporation, ticker L.
Right. Lowe's also operates as a diverse conglomerate. They're known for an extremely conservative management style and long-term focus across subsidiaries spanning insurance, energy, and hotels.
So if the market dictates a need for a multi-industry, conservatively managed alternative to Berkshire, Lowe's is positioned to attract that flow.
So across these three categories, we've identified clear paths to gain. Operational weakness benefiting insurance rivals.
PGRALLTRV.
The strategic deployment of capital benefiting advisors.
GSMS, JPM.
And persistent uncertainty leading to asset rotation toward philosophical peers.
MKL and L.
Now we change perspectives to examine the entities facing pressure due to the executive transition. This segment focuses on categories that face repricing, capital flow risk, or a negative narrative change.
And in a necessary but perhaps obvious start, the first and most direct loser category is Berkshire Hathaway itself.
You have to start there.
You do. The inherent risk here is the succession discount translating into sustained valuation compression.
We've already noted the immediate price action. But the long-term risk isn't about operational failure. It's about the market actively reducing the perceived value of that Buffett premium.
Right. That premium was built on an unmatched combination of factors. His unique counter-cyclical purchasing power, his reputation for acquiring high-quality assets at distressed moments,
And the unmatched trust he generated through shareholder communication.
Absolutely. So even if operations run perfectly smoothly under Abel, if BNSF continues to move freight and GEICO keeps writing good business, the market will not simply hand that premium over to the new CEO.
The pressure we're seeing is a natural repricing of that governance risk, and it will likely persist until Greg Abel has amassed a clear, public, and successful track record as the chief capital allocator.
The market operates on proof, not faith, especially when it comes to valuations of this magnitude.
So the stocks that directly reflect this discounted valuation are the two share classes of the company itself. Berkshire Hathaway, Inc., Class A, ticker BRK.A.
And Berkshire Hathaway, Inc., Class B, ticker BRK.FB. These shares are the literal representation of the valuation challenge presented by the end of the Buffett era.
Okay, so moving to our second loser category, we examine the companies most directly impacted by the portfolio management decisions, Berkshire's largest overhang positions. The risk here is flow pressure and a negative narrative resulting from the assumption that the trimming observed in the past will continue.
We rely on the public reporting that confirms Berkshire has already been reducing its stakes in two of its most prominent holdings. And the analysis assumes that this trimming was a strategic process and that it will either continue or maybe even accelerate under the new leadership.
As Abel seeks to rebalance the overall equity book or raise additional cash for large acquisitions.
Right. And if the market believes this trimming is structural and will continue, it creates a quantifiable structural headwind for the affected companies.
Every time the market anticipates or confirms a sale by Berkshire, it acts as a technical flow of shares hitting the market.
And that's coupled with the damaging narrative that one of the world's most disciplined investors is losing confidence in that position.
The two companies facing this specific pressure are central to the U.S. equity market landscape.
Very central.
First is Apple, Inc., ticker AAPL. Apple is a titan, and its status as Berkshire's largest holding makes any reduction highly consequential.
The sheer number of shares that Berkshire holds means that even minor reductions translate into a substantial flow of shares that must be absorbed by the market.
And that could potentially depress the price, irrespective of Apple's underlying product success or quarterly results.
Right, and the narrative surrounding Apple is also critical. Reducing the stake signals a potential shift in concentration preference, or maybe a lower comfort level with a single stock dominating the equity portfolio, a philosophy the new leadership may embrace.
Second is Bank of America Corporation, ticker BAC.
This is a core holding within Berkshire's financial sector exposure. So continued trimming of Bank of America signals a potential cooling of enthusiasm for that specific, highly concentrated financial exposure moving forward.
Which sends a negative signal to other institutional investors who rely on Berkshire's investment moves as a sign of long-term sector health and valuation comfort.
Exactly. Our third and final category of losers addresses a narrative adjustment. High valuation, mega deal hopefuls.
Okay, so the pressure here comes from a lower probability of a white knight mega bid acquisition occurring.
This is a nuanced point about market psychology, and you could call it a fantasy premium.
Right. For many years, certain massive, high-growth, but often fully priced companies traded with an implicit fractional premium because investors held on to the hope that Berkshire Hathaway, the buyer of last resort with enormous cash reserves,
Might step in and acquire them, thus putting an ultimate floor under their valuation.
that fantasy has always been tethered to the unique perspective and aggressive deal-making of Warren Buffett.
But Berkshire itself has repeatedly stated how difficult it is to find acquisition targets large enough to move the needle for a trillion-dollar company without vastly overpaying. Abel inheriting this problem only compounds the difficulty.
So effectively, the transition dampens that long-standing fantasy of an easy Berkshire takeover. The market is now being forced to price these potential targets based strictly on their operational execution, revenue growth, and near-term profitability forecasts.
Removing that slight Berkshire buyer premium.
So who are we talking about here?
The companies identified here are known for their enormous scale, and they're typically high valuations, meaning they benefit from any reduction in this acquisition narrative support.
The first is Salesforce, Inc., ticker CRM.
As a leader in enterprise cloud software, Salesforce operates at a scale that makes it an immensely expensive takeover target, likely requiring hundreds of billions of dollars.
And the assumption that the new Berkshire management would attempt such a massive, pure technology play, which falls outside of Berkshire's traditional industrial holdings,
is now significantly less credible.
Okay. Second, Netflix, Inc., ticker NFLX.
Netflix is a massive consumer subscription service, trading at a valuation and scale that would also be immensely challenging. Acquiring it would require not only a significant outlay from that $381.7 billion liquidity reserve,
But it would also represent an entirely new, potentially risky strategic direction for the conservative conglomerate.
Yeah, so the cooling of the mega bid fantasy impacts how investors view their long-term high-growth valuations, especially when compared to their actual cash generation.
So the pressures are layered. Direct stock repricing for Berkshire itself, technical selling and narrative risk for its core holdings like AAPL and BAC.
And the collapse of a specific takeover fantasy for large, expensive growth targets like CRM and NFLX.
This entire setup, the immediate reaction, the identified winners, and the documented losers, it all pivots on a single overarching question that will define the market for the next few quarters.
It does. The core question for the market is whether this initial market reaction is truly just a short-lived dip in sentiment, correcting itself as the initial transition noise subsides.
If so, it's a minor blip.
A minor blip. Or will this event evolve into a longer, more structured process of re-rating the stock's valuation?
The latter meaning the market imposes sustained pressure, and the succession discount remains until Greg Abel successfully proves his capital allocation strategy in real time.
Over a series of earnings cycles and major deployment decisions. The answer to that question dictates whether the identified winners and losers experience brief volatility or the start of sustained trends.
And this analysis gives you the context needed to evaluate what comes next in the world of Berkshire Hathaway and the companies that orbit its strategic decisions.
Now, we do want to remind you that this is not financial advice.
The information discussed here does not constitute any buy or sell recommendations. This content is purely the opinion of the author of the material we reviewed.